Your job as a treasurer is to squeeze and minimize the risk that is unwanted, meaning the 50-50 zero expected return, so the rest of the business can allocate it to a place where you can get a positive return by taking risk. And where's that? Well, that's your operations. That's your core business. This is why you're in the business. If you take no risk, you get no return. Why? Why do you put on a seatbelt in a car? If you think about it, the chance of you getting in a car accident on any given trip is so small. You don't want to take the risk, no matter how small, of getting in a catastrophic car accident and getting injured. Why in a business you don't think about the catastrophic risk of a bank failing? Because banks can and do fail occasionally. You'll probably see a few of them happening in your lifetime.
Welcome to Turpentine Finance, a podcast where we talk with top founders and finance leaders about what it takes to architect success. Our guests speak candidly about big business inflections, market curveballs, and how they approach decision-making so that you have the tactics and mental models for when the pressure is on. I'm your host, Sasha Orloff, founder, CEO, and self-professed finance nerd. You ready? Let's dive in. Hi, everybody. So some of you might have heard of this concept of treasury. One of those things where, kind of probably like your heartbeat, you don't really pay attention to it until it becomes the most important thing in life. Treasury departments are a vital part of companies' operations, and they help you optimize financial resources, manage risk, something that is one of those things where if treasury comes top of mind, you know immediately what we're talking about. And if you don't, you should listen in. It can help ensure that a company has enough cash to meet all of the short-term obligations while still having funds available for investment in long-term growth. Treasury departments can help companies comply with financial regulations, something that doesn't sound too sexy, but is incredibly important for all of us out there, help avoid legal penalties and damage to a company's reputation. They also help companies find the best sources of financing and leverage investments so that you can build a long-term enduring business, something we all work very hard to do. So I wanted to learn more about treasury as a function and peel the onion back. So today, whether you're a founder managing risks, you are growing and scaling your business, you're a budding CFO, or you're just a treasury person wanting to just get better, I invited one of the bests, Eugene, here to the show. So Eugene's a career treasury executive from some of the largest companies in the world you might have heard of, like AT&T, and hardware companies like SanDisk and Cypress Semiconductor, and software companies like 6th Sense. He comes from an engineering and a CFA background, so this should be a fun conversation from high level down to the weeds. Eugene, welcome to the show.
Thank you, Sasha. So for those of you who have not heard about treasury at all, that's perfectly okay. You came to the exactly right place. And by the way, at one point, I did not know anything about treasury either. I kind of heard it was treasury, sounded cool, like there's some treasure there, sounded adventurous, sounded exciting. Turned out it was pretty exciting. For those of you that might have heard things about treasury and kind of think it's cash and banking, you came to the right place as well. And I'm looking forward to give you more depth on treasury and explain to you what treasury is and what treasury does and give you additional dimensions. And for those of you who know treasury inside and out, and you make it to the end of this podcast, I would really value your feedback. But first of all, Sasha, thank you so much for having me on the podcast. I'm super excited to be here, and I'm really looking forward to our discussion today.
Awesome. What a great intro. I love it. We're always learning. We're always trying to get better. And treasury is kind of one of those, like, sometimes like obscure things, and it can become complicated. So for somebody that has no experience in treasury, how do you just describe the treasury function and why is it important?
Absolutely. So first of all, let me say that pretty much every company on the planet has treasury tasks that they execute. They might not be fully aware or cognizant of it, but they do that. Even without dedicated treasury function, you still have treasury work to do. It just falls to other groups in the company. So that piece that I'm talking about is something called cash management. You need to open bank accounts. You need to make sure your payments flow. You need to make sure you have enough cash. You have to kind of think about at least a short-term cash forecast. So there's the cash management piece, and it's really has to do with the plumbing of the cash system and making sure there's enough cash that it flows to the right place in the right time in the right amount, right? So no wonder they call it liquidity, right? It all has to flow and it has to be the right plumbing set up for it. That piece is pretty intuitive. What gets a little bit trickier is the risk management piece. And I'm not just talking about insurance, even though insurance is definitely part of it. but just managing any type of financial operational risk that could impact the business. First, you have to assess it. Then you have to kind of quantify and find ways to mitigate it, or at least make informed decisions of what you want to do with that risk. And then there's the capital markets piece that kind of sits in between, maybe has one foot in cash management, because you need to make sure you have the right, either you have investing excess cash, or you need to make sure that you have the funding and the cash and liquidity to operate. But it's also exposed to a lot of different market risks. Interest rate risk comes, top of mind, for example, right? So you've got cash management, risk management, and then capital markets kind of has a foot in both.
Got it. So I think some of them sound obvious, but can you tell us from your experience, or some you've heard of, since I'm sure you think about this stuff all the time, what are some of the things that can go wrong if you're not paying attention to Treasury?
Yeah. So it's the risk component that's kind of, again, sometimes misunderstood. And when you don't properly address risks, things can blow up. Things can be, have these unintended downside surprises. And sometimes outright, they can blindside the company. I'll give you one example. During the SVB collapse, a little over a year ago, I know a story of a founder. They had a small startup. They had some seed funding, had comfortable runway for, I'm not sure what the exact amount of time was, but it was comfortable, maybe 18 months or so. And that weekend when SVB collapsed, he was in absolute panic because his 18 months of runway all of a sudden became 2 or 3 months of runway, right? So here you are, you focused on getting your business off the ground, you're building product, you trying to find new customers. You don't think about, all of a sudden your runway going from 18 months to 3 months, for example, right? And it happened. It could have, he lucked out. We all lucked out on this one, but it could have gone in a very different direction. So if you want to think about this risk and why companies pay attention to it or don't pay attention to it, I like to tie things to real world examples, right? So I'm going to ask you, Sasha, when you get in a car, do you put a seatbelt on? And by the way, if the answer is no, don't say anything, because I don't want you to incriminate yourself on your show. So do you put on a seatbelt when you get in the car? Yes.
Yes, I do. Yes.
Well, why? Why do you put on a seatbelt in the car? If you think about it, the chance of you getting in a car accident on any given trip is so small. I mean, the expected number of times folks are going to get in serious car accidents in their lifetime is hopefully in a very low single digits. So for any given trip, your likelihood of getting in a major car wreck is extremely small. Yet we get in there and we put a seatbelt on. Well, of course, we don't want to take the risk. But let's transfer that case to the business now. You don't want to take the risk, no matter how small, of getting in a catastrophic car accident and getting injured. Why in a business you don't think about the catastrophic risk of a bank failing? Because banks can and do fail occasionally. You'll probably see a few of them happening in your lifetime, right? So that's kind of how you think about risk. In one aspect of your life, you get it and you exercise, good risk assessment and good risk practices. But in business, somehow a lot of times we overlook it.
I think it's the thinking about, right, the cost of not doing it can be catastrophic, can be binary. And so why take the chance? Keep going. Sorry.
Yeah. And risk gets pretty complex, and we'll talk a little bit more about it, right? This is kind of an easy example. There's only downside risk. It doesn't cost you that much to, address this risk. The downside could be catastrophic. So why not, take the small steps to take a look at it? Some other risks become a little more costly to address. Risks, it's a downside, but there's upside as well. And we can get into that. And I can walk you and the listeners through of why it's still important to address those risks and when you should do that.
Well, you've talked a little bit, actually, if we sort of bring this to life now, over your course of experience in Treasury, you've worked in a couple different types of industries. Can you kind of bring to life, like, what's the job of a Treasury person like in a big global multi-entity or AT&T, like a big, huge, long-standing company versus, say, a manufacturing company where there is sort of supply chain issues, and then a software company? I would love to hear, sort of bringing it to life to people, your job in these different types of industries.
Yes, industry definitely matters. And there's definitely industry-specific aspects of it that make you an expert and make you more effective if you have the particular knowledge. But also things in Treasury within the same industry two companies can be diametrically opposed from how you approach them. For example, if you work in a company that has a lot of cash on a balance sheet, treasurer worries about investments. If you work at a company in a capital intensive business, say like semiconductors, that trying to build new fabs and they have to borrow a lot of cash, then you're worried about debt and you're worried about going to capital markets, refinancing your debt, et cetera, right? For companies like AT&T, it's a utility, very debt heavy, right? So there's a lot of focus on issuing debt, on locking in interest rates, and trying to figure out the most efficient way to issue debt. AT&T was so big, right, and had so much debt, it kind of started to exhaust U.S. capital markets for debt. So what we're actually doing, we're issuing debt in euros and GBP, and then, of course, that creates new issues, like you have a currency risk now. So then you have to hedge that debt. So you have to go to different markets, and then you have to layer a currency hedge on top of that. There's just one example. But if you're talking about manufacturing versus software, right? The interesting thing about software is you don't have a lot of real things, like you don't have widgets to deal with. So on the one hand, it makes things simpler. On the other hand, other things become more complex in software. But if you do have these widgets, like you have the inventory, you have to worry about something happening to your inventory. More importantly, supply chains get very complex. And supply chain, it's literally a chain. And if one link breaks, the whole production breaks, right? So you need to worry about every node of your supply chain and assess the risk of that node and figure out how you're going to mitigate if something happens to it. These things happen occasionally for large manufacturing companies when either their facility goes down or one of the suppliers' facility goes down, and they need to find a quick workaround. I'll give you a very real example that I lived through when I was with Cypress that was eventually acquired by Infineon. We had a fab in Austin, and on Valentine's Day of 2021, Texas experienced a freeze. It was very unusual. Again, talking about these risks, right? Who would have thought that Texas would have a freeze and utilities would not be able to keep up? Well, we lost power, gas, and water to the facility. And in a semiconductor environment, you depend on having your filters running to keep the air clean. Once the air is not clean, the production gets contaminated. You lose the inventory, which itself is costly, right? But you also don't have a product to sell. It takes a long time to remanufacture that inventory. And, in the meantime, you're still incurring all your fixed costs while you have no product to sell. It's a huge economic impact. Luckily, there was insurance for it, right? But you have to think about these things. What do you insure? To what degree? If this happens, do you have a backup plan? Should you keep more inventory on hand somewhere in a warehouse, right? It's costly. Nobody wants to keep extra inventory. But if your supply chain is vulnerable, maybe that's a better way to go. So it's those kind of things you got to think through. And then if you are operating a company that's multinational, you introduce two headaches for Treasury, right? First, every entity needs its own banking infrastructure, right? You got to set up the plumbing I was talking about. You have to set it up for every entity in every country. And it's very boring. It's very mundane, but somebody's got to do it, and it falls to the Treasury. The second headache that you start dealing with, if you operate in different countries, chances are at least your expenses are denominated in local currency, and then you have currency risk. So you got to worry about currency risk, right? So it's those kind of challenges, and it snowballs. And then I'm not even going to any kind of regulatory things because that's really boring. But again, somebody's got to take care of it.
Hey, we'll get back to the conversation in a moment after a word from our sponsors. Hey, finance leaders, do you remember when Amazon didn't have to charge sales tax on every online purchase? Well, 10 years later, we see sales tax on e-commerce everywhere. That wave is now hitting SaaS and the digital economy, and Anrok is here to help you navigate this new tax compliance journey. As your software business grows, so does your global tax liability. But keeping up with ever-changing regulations across multiple jurisdictions can be overwhelming. That's where Anrok comes in. Anrok is the enterprise-grade solution that automates sales tax compliance worldwide. Anrok tracks your exposure, calculates tax, and handles filings all in one platform. As a Turpentine Finance listener, you can get a free Nexus study from Anrok today. See your economic and physical nexus in real time by connecting your billing and HRIS tools. You'll get a clear view of your exact exposure in any jurisdiction, plus a live review with a SaaS tax expert. Don't let tax compliance slow down your growth. Visit anrok.com/turpentine to claim your free Nexus study and take control of your SaaS tax strategy. Anrok, empowering software businesses to grow across the globe.
What does the future hold for business? Ask 9 experts and you'll get 10 answers. It's a bull market. It's a bear market. Rates will rise or fall. Can someone invent a crystal ball? Until then, over 40,000 businesses have future-proofed their business with NetSuite by Oracle, the #1 cloud ERP, bringing accounting, financial management, inventory, and HR into one fluid platform. With one unified business management suite, there's one source of truth, giving you the visibility and control you need to make quick decisions. With real-time insights and forecasting, you're peering into the future with actionable data. When you're closing the books in days, not weeks, you're spending less time looking backwards and more time on what's next. If I had needed this product, it's what I'd use. Whether your company is earning millions or even hundreds of millions, NetSuite helps you respond to your immediate challenges and seize your biggest opportunities. Speaking of opportunity, download the CFO's Guide to AI and Machine Learning at netsuite.com/102. The guide is free to you at netsuite.com/102. That's netsuite.com/102.
I find this stuff fascinating. So I think as we think about sort of global multinationals, that makes a lot of sense. There's sort of your FX, and there is timing between sort of issuance maybe of debt and collections. I get it when there's supply chain as well, and sort of like breaks in supply chain. I get it when there is large companies. Right now, you're at a software, and then actually my last company, which was the first mobile lender, the first venture-backed credit card, obviously Treasury was a key component in payments companies. You're now doing Treasury at a software company. So I'd love, when should a software company think about hiring a Treasury person? And what is like a lot of your job responsibility now in Treasury in a tech company?
Yeah, as far as job responsibilities, you still have the same traditional ones. For example, debt, right? We've closed a great credit facility last year. Right, credit facilities give you additional cushion, additional liquidity, and that's important for any business. Cash management does not go away with a software company. You still have people, you still have customers, you still need to run all that. We are multinational, so FX risk is present. Even if you're not hedging, you still have to look at it. And all the other risks, like counterparty risk. I'll give you an example. The SVB collapse was kind of a big shock to the system. SVB was our sole bank at the time, right? And, it was a very tough weekend. Luckily, because, if you have a treasury and they're looking at counterparty risk, we've actually launched a separately managed account to park a lot of the cash for various reasons, reduce counterparty risk, but also to manage the cash better, to maybe even get a little bit better yield. It's a custodial account, which means that your money gets this extra layer of protection. So if you have a treasury, you're kind of thinking about these things and you do them ahead of time. When SVB collapse happened, the very first thing that was very clear is that our money is 100% safe. Now, the plumbing component might be broken and we need to figure that out. But the treasure of the money, that's safe, right? And that gave a lot of people relief right away. I've heard of other companies that actually were not as fortunate. It all worked out in the end for everybody, but they were not as fortunate, and some of their cash was at risk. Even if they parked the money in the money market funds, that's the way the funds are structured and the way the legal agreements are structured. The money market funds were not subject to any kind of bankruptcy of the bank itself. But the bank offered a particular product called, I forgot it was, I think it's called TAS, but it was basically an instrument that was a blend of bank deposit and treasuries. And because banks pay more on to attract the funds, right, that blend had a better yield than just money market funds. And a lot of people were attracted to it, like, well, let me park the money in this product. I get better yield and it's safe because, I'm not locking anything up. Anytime I want to, I can just take the money out, right? And I've heard of companies that got into that product, and when the music stopped, so to speak, their money was still there. And that portion that was on bank's balance sheet, that was truly at risk. So it's those kind of things, whether it's software or not, you have to kind of go through these steps to make sure you mitigate them, right? I mean, we still have cash. I mentioned the investment portfolio, right? A lot of software companies, especially VC backed, you get a funding round, you have a lot of cash on your balance sheet. Maybe if you're earlier rounds, it doesn't make sense to necessarily go beyond money market funds, but later rounds, you have $300 million. Do you want to leave it in a money market fund? Not because it's not safe, but because money market funds, what they do is they provide you the next day liquidity. And you're generally paying for that. This next day liquidity usually does not come for free, right? So if you don't need it, why are you paying for it? That kind of thing. And, on this theme of, how do we optimize, how we make things more efficient, how we save costs, right? There's all kinds of areas that I consider low-hanging fruit. On the topic of money market funds, do you know what your expense ratio is for a money market fund? If you don't, look it up, compare. Chances are you're paying extra 10, 15, 20 basis points versus something else you could have, right? Money market funds, even government funds, they're not created equal. We talked a little about foreign exchange, right? If you're operating in a global environment and you either have customers that pay in foreign currency or you have employees that you need to pay in other parts of the world, right? Somewhere a conversion happens, whether it's in your bank, at their recipient's bank, somewhere, somehow, the currency goes from local currency to USD, right? It has to, right? And the question is, do you know where this conversion happens, and do you know the rate that you're getting? Well, people are gonna say the rate depends on the market, right? You don't know what kind of rate you're gonna get. 100% true. But in addition to the market fluctuations, there's usually a spread or surcharge that a lot of institutions that are in the business of transacting foreign currency will add on. And the question is, do you know what that spread is? If you do not know, chances are it's probably higher than it should be. And by looking into it and negotiating, you can probably get a much better outcome. So again, these are just a few examples. I'm sure there's like half a dozen more, but hopefully it gives the listeners a little bit of a concept of things that Treasury deals with, even in software companies.
What I really like about what you're talking about is sort of at least understanding where the risks are, because there's a risk to everything that we're doing as operating and building businesses. And so the first step is about understanding what the risks are so that you can make an informed decision about how much risk you want to take. One of the things we talked about before this call, which I thought was really fascinating, was something you said was, when I asked about how do you think about allocating risk, you talked about thinking about risk as a budget. Can you talk a little bit more about what that means?
Yeah, absolutely. And I mentioned earlier that, risk gets complex, especially if you're in a situation where you can have downside and upside. I've heard a lot of people ask me well, Eugene, if let's say a foreign exchange risk and, the currency can go up, it can go down. Maybe you gain 5 million, maybe you lose 5 million. Why do you bother to hedge? Or if you're hedging, well, you can lose money on your hedge too, just as easily as on underlying. Very valid questions. The way to think about risk is to step back and look at how the company can operate overall and how is the company funded and what your cost of capital is. Your cost of capital is determined by the riskiness of your business, or by how volatile your business is. If your business is very volatile, regardless of where the volatility comes from, right? If you say a public company, you're going to have high beta companies end up paying more for their capital. So for a given level of risk, right, that you can take, I think of it as a budget. If you take too much risk, no matter where you take, your investors are probably not going to like it. So now the question becomes, you have this risk budget, where do you allocate it? Do you want to allocate that risk or take that risk in this kind of a 50-50 proposition, right, where the expected return is zero? And I'd say on foreign exchange, most companies are not in the business of predicting foreign exchange rates, even though some try. I don't know why, but some think that they can beat the market. And that's a 50-50 risk, right? Meaning that expected value is zero. Do you want to allocate your risk in that area, Or do you want to find ways to allocate your risk where expected return is positive? And I would say your job as a treasurer is to squeeze and minimize the risk that is unwanted, meaning the 50-50 zero expected return, so the rest of the business can allocate it to a place where you can get a positive return by taking risk. And where's that? Well, that's your operations. That's your core business. This is why you're in the business. If you take no risk, you get no return. You get risk-free return. So you started a company because you're good at something. You're better at something than most other people on the planet, right? And you're building a product, you're providing a service, and it's not guaranteed that it's going to work, but if it does work, you get an outsized return, and that's where you got to allocate your risk. So the job as a treasurer is to basically squeeze all this bad risk out, reduce the volatility so you can take the risk in your operations. Let me give you one example, a conversation I had with our CFO. That was kind of a little bit eye-opening for me, which is like, why didn't I think of it first kind of thing. So when I was at Cyprus, we had exposure to Japanese yen on both the revenue side and expense side. And these were offsetting exposures, meaning, we get some revenue in Japanese yen, we also pay expenses in Japanese yen. And the expenses were higher than the revenue. So you kind of think, okay, well, maybe you just hedge the net exposure that you have. However, we're hedging growth. So we're hedging revenue and they were hedging expense. So we're basically buying derivative to sell the yen and buying derivative to buy the yen, right? And I'm like, well, they're kind of offsetting. Let's just focus on the net position. And, there are reasons why there's a benefit to that. With all the hedge accounting rules, it would have made it much easier. So I'm talking to our CFO, and what he said was absolutely brilliant. He said, I'm guiding to EPS and I'm guiding to the revenue number, right? There's so much variability that I need to worry about in the revenue number when we providing guidance. I don't want this extra variability coming from FX. So that's why I want you to hedge revenue on a gross basis to make sure that my guidance is not affected by something I have no control over, like FX. Again, I thought it's like, wow, that's a brilliant answer. And I went back, I'm like, I felt stupid for not thinking of it first.
We always are learning and improving. It's part of the fun of kind of going to different companies and learning and having great bosses. Hey, we'll get back to the conversation in a moment after a word from our sponsors.
Real talk. Most talent leaders haven't yet cracked how to leverage AI for meaningful impact on their hiring processes and business goals. But the leaders who are effectively using AI to transform their recruiting team's efficiency and quality use Metaview. Metaview is the AI assistant for the interview process. Their AI records and transcribes hiring conversations, like intakes, interviews, and debriefs, then provides perfectly summarized notes of everything that was discussed. That means your people can focus on creating a human connection with candidates during calls and save time on the busy work of cleaning up notes after every interview. But it's so much more than just a time saver, because perfect notes means perfect data. For every candidate and every pipeline, hiring teams can make confident, informed decisions, and talent leaders can finally take control of the interview process. Join forward-thinking talent leaders at high-performing organizations like Brex, HelloFresh, and Quora, and check out Metaview. Head over to metaview.ai/heretics to talk to one of Metaview's product experts or get started for free. You'll be up, running, and AI-enabled in minutes.
Omneky uses generative AI to enable you to launch hundreds of thousands of ad iterations that actually work, customized across all platforms with a click of a button. I believe in Omneky so much that I invested in it, and I recommend you use it too. Use COGREV to get a 10% discount.
We talked a little bit about kind of the why Treasury is important and where it exists and is quite obvious. Maybe let's talk a little bit more in the early days of a company that is growing who might be needing a treasury, either a full-time or a part-time, or start to think about treasury and cash management thing. How do you know when, in the early days, how do you know when you should start, when a company should start thinking about this? And what would be an inflection point in which it justifies having a full-time hire?
Yeah, I don't think there's like a magic indicator saying that, the bell goes off, you need to hire a treasury person. But I would say that at some point, these treasury tasks that exist and they're basically done by other members of the team, If that becomes overly burdensome, that's one indicator that you hire a treasurer or somebody in treasury. The other indicator is if you don't understand your risks, or if you're aware of the risk but you don't know what to do about it, that's another indicator.
Can I pause there? I think that makes total sense. What is a question that a founder can ask of their finance team, or a finance team can ask of themselves to help understand, do they understand the risk of their current treasury or lack of treasury function?
Yeah. So the risk itself, like, it's a little bit of a difficult concept. I would ask, when the founders or the executive team meet, right? There's always a plan, a base case plan, right? There's some budgeting process that happens. There's some goals and projections that are being made. And sometimes maybe even there's downside plan, upside plan, things like that. But the question that I think is a good one to ask in that situation, if this is our plan and we fail, what can bring about the failure, right? What could go wrong here? Right. And if you start running into the answers like, we're dealing with one bank, it can go under and we can lose our money. Is that a big deal? Yeah, it's a big deal. Okay, there's a risk. How are we going to deal with it? Right. If you're saying, our cost structure is such that we depend on a particular currency to be below a certain threshold, otherwise our business unit economics get broken down, then it's like, okay, if that currency goes past the threshold, what do we do? And do we need to buy ourselves time to figure things out? Do we need to hedge? So I think a lot of it has to do with what if scenarios and really understanding the drivers of your business, and also really understanding those external factors that affect your business. That's the piece that a lot of people are not focused on. And that's actually having the treasurer lens. A lot of times when I'm in a situation, I look at other external factors that are not usually part of the equation and thinking how those factors could impact. And if you find yourself in a situation where you're faced with something that's not very likely, so low probability or low frequency event, but has high severity, you got to pay attention to those, right? High severity, high probability. If you're constantly faced with that, something wrong, right? You can't operate a business like that. If it's, high probability, but low impact, you kind of know how to deal with it, right? It's like it becomes kind of a cost of doing business and you can deal with it. But it's those low probability, high impact events that you really got to worry about.
That's good. When you think about either you stepping into a new job or a company hiring their first treasury person or going through the first kind of evaluation process, what are the 2 to 3 common problems you see that a treasury person, treasury function might have in their job? And how do you recommend solving, given your experience?
Yeah, so there's 2 parts that I see here. One, like, what would you do kind of coming in? Like, how do you even evaluate what's happening? And then what issues or problems treasury functions face within the company, and how do you mitigate or interact with other stakeholders to make sure that you provide the right service? On the first part, kind of stepping into a new company, whether it has a treasury function or not, first thing I would do, and this is somewhat mundane, but I want to see the org structure of the company, legal entities. I want to see where the business is done and where the revenue is coming in, where the expenses are, and then understand that how the cash flows to the company. It's very important because a lot of focus outside of treasury is on P&L, but it's the cash piece that can really derail your business. It's the cash that's really important and what matters at the end of the day. Not cash even on a total level, but making sure you have liquidity in the right place, right? You might be well funded in one entity, but then another entity has no cash and you need to plan for it. You need to do something about it ahead of time. So understanding how the cash moves to the company is extremely important. Second piece is I want to see what, if there's existing set of controls and policies, understand what these controls are and assess, do these controls address all the risks, right? In my mind, a controls is not something like, we do this because the auditors asked for it, right? Sometimes I've heard that mentality, like, why do we do this? Well, it's for the audit. Like, well, why do we do it? Like, I don't know, the auditors asked for it. Like, no, your controls should be, there's a particular risk that we've identified that the business is facing, and we need to mitigate this risk, and we put a control in place that's going to mitigate this risk. So I want to understand what these risks are and controls are that somebody already identified. And then you want to take a broader look at the business and say, is there anything else that's missing? What else can kind of blow up or derail our business? And then on the second part, what are the challenges that Treasury has in general? I'd say there are two issues. One, Treasury itself is a very fragmented function. And what I mean by that is that there's areas of Treasury that don't seem to be related to each other, not closely related to each other. For example, investments might be somewhat related to cash management, but it has no relation to insurance, right? Or, you have within insurance itself, you have workers' comp, for example, and general liability that are very different from directors and officers of insurance. So there's all these kind of fragmentations, and they serve different stakeholders, right? And then you end up touching all different areas of the business, and you have to be able to make sure that you articulate what you can do for them, and B, what you need from them in order to make your job successful. So it's this fragmentation, and then within each area, it's basically, some of it has its own lingo, right? You have to learn the lingo, you have to be able to communicate to others, and communicating these priorities and the concepts that Treasury faces. Like we talked a lot about risk, but it's hard to explain to somebody that, hey, I need an accurate forecast from you because I need to understand what the currency risk is. And no, I don't need the revenue in total converted to dollars. I need the revenue by specific currency. So it's crucially important that we get this forecast in the right currency. Because I've seen a lot of times like, oh, here's our projections, right? But I gave me the data that I really need. And you really need to educate your stakeholders and your partners on what it is you need, but also why you need it, why it's important. And so that's where explaining the concepts becomes very crucial. And it's not an easy thing sometimes.
This is eye-opening because there's so much more potential. I guess I naively thought, all right, Treasury is kind of matching your cash balance and making sure that it's always going to clear, and you don't have insufficient funds or some other like unnecessary thing, or maybe I guess run out of money. But you've opened my eyes to like a lot of other possibilities of what Treasury can do. So I guess maybe where does Treasury sit in an organization, and what do you think separates Treasury function from a great Treasury function?
Yeah, so as organizations evolve, right, you kind of talked about the cash management being done by other functions, and that usually falls onto primarily accounting functions. So a lot of times controllers kind of inherit the Treasury tasks as the company grows, and then they get to a point like, well, we need somebody to do this particular work because our accounts are tied up and they're not experts on this. So in the smaller companies, what I've seen, the Treasury function rolls up to the controller. And then all these capital markets activities, going to, negotiating a loan with the banks or something like that, that usually falls to the CFO. So that's kind of split. It works well as long as the risk component is not something that is a major concern. It should be a major concern, but maybe the companies don't have to put a major focus on it. Because from the controllers and accountant perspective, they're very good at the concept of, cash management, because it's kind of like accounting. It's very, very deterministic, right? There's certain amount of cash comes in, certain amount of cash needs to go out, just like accounting. There's an entry that's being booked. You need to make sure it balances and make sure it matches. The risk is that kind of a probabilistic function. I'm talking in AI terms now, but I think there's a good parallel, right? And that, that's a harder concept. So again, it works well kind of in this growing organization when Treasury function sits within controller's org. But at some point, as it becomes larger, companies carve it out and it's a separate function that reports to the CFO for a couple of reasons. One, because the risk needs to be kind of managed by its own function, and it needs to be outside of accounting because it needs to touch so many other areas of the business. I'm talking about operations, legal, right? I mean, there's so many interface points. And second, because of that capital markets activity that fell into CFO, and now CFO says, hey, the company's bigger. I need to do a lot of stuff on my own. I can't be bogged down on this. We need a treasurer to go take it over. So then the treasurer takes over all of the debt issuance, all of the investments, and all of, I don't know, if there's a hedging question that comes up, like, hey, who's going to do that? Like, the treasurer can go and address all these issues.
So I might be biased because I build accounting software and I think it's fascinating and I have a background in math. I could see there's some people out there who might not think treasury is the most exciting job in the world or the best career path. What is it for you that gets you excited to have this be your career path?
Yeah, no, I can see their point of view, and I can definitely understand
they're
that
wrong.
A lot of mundane
Obviously,
things,
they're wrong. Totally wrong.
Yeah. Well, I'll agree with them that there are a lot of mundane things within Treasury, like in any other function. And, regulatory compliance is not the most exciting thing. Filling out a bunch of forms to open a bank account, not the most exciting thing. That's not what gets me out of bed in the morning. But here are two things about Treasury that are exciting. One, it's a very externally focused organization, right? So a lot of functions within the company are very inwardly focused. Treasury has that one foot in the company, one foot outside the company. So you deal with a lot of external institutions, dealing with banks, you're dealing with insurance companies, with insurance brokers, you deal with markets. You need to be the guy who knows what's happening outside the company and who can be an expert on it, because guess what? Company does not operate in a bubble. It will get impacted by those forces. And you're the guy or gal that needs to know what these forces are and how they can impact the company. So that's exciting. I'll give you one quick example. When I first started AT&T post business school, I did a couple of BU finance rotations that had its own interesting aspects, but it was so much focused on targets and budgets, and somebody gives you a target, you just got to come up with a budget. You kind of live within this world. And I was doing all my CFA exams at the time. There's CFA exams take 3 years to pass, right? At least 3 years. So I'm learning about all these markets, about all this cool stuff. And all I'm seeing is the budgets within the company. I'm like, there's more to it out there, right? And then that's why I wanted to come to Treasury. And when I came to Treasury, I'm like, oh, that's the nerve center. That's where everything's happening. That's so centralized. And you're dealing with all these banks. Actually, when I got to Treasury 3 months later, Lehman collapsed. So I had the front row seat to everything. That was exciting, right? The second part that I think is very cool about Treasury, treasurers live in a cash world. You can argue that, maybe CFOs live in the P&L world and the rest of the company lives in the P&L world. Treasurers live in the cash world. And cash is where rubber meets the road, right? Yeah. Cash, it's either in your account or not in your account. You don't accrue for cash. You don't we're just going to capitalize this expense. And no, it's either there or it's not. It tells the truth, right? And again, it's that externally focused, right? Rubber meeting the road. You got to have the cash.
Yeah, I love that. You deal in the world of reality, not in some potential fantasy. And that's got to be exciting. You see the actual cash flowing and moving around. What are some of the tools you need to do your job, whether it's like software or other sort of systems or people or resources?
Yeah. So as far as tools and systems, right, there's been a lot of obviously technological development that affects Treasury as well. Believe it or not, you can get by on Excel for some time. And I'd say that while Excel is not the answer, Excel is not going away either. But in addition, there are great tools. There are a lot of different systems. They're called treasury management systems or treasury workstations that specifically cater to Treasury. Treasury's kind of software and tech stack is a little bit separated from the rest of the company. Just like Treasury functions a little bit kind of, let's say, one foot in the company, one foot outside. If I'm thinking about my Okta tiles, right? And a lot of companies use Okta and you log in and you have all these tiles. Pretty much every application has an Okta tile. You're not going to find, in most times, you're not going to find an Okta tile for your bank login, right? That's going to be outside. So by the nature of your work, your systems don't necessarily live within the full ecosystem of the company. So, some don't. But yeah, so you need Treasury, some kind of Treasury software to automate your functions, to maybe help you with forecasting. There's now AI components that help you with kind of predictive forecast on collection. At least they see, hey, here's been the pattern. You forecasting something different. Why is it different? Or, hey, you're forecasting this, but we've seen this in the past. kind of keep an eye out on it for it. And then there are also tools that need to keep you informed, right? I mean, most people read the news, but if you really need to pull up a lot of financial data, I've used Bloomberg many times. I'm not trying to make a plug for Bloomberg. There are other tools. There's Thomson Reuters, right? But you need some kind of a market data that you can access. Or, if you're trading currencies, and a lot of companies do execute their trades, right? You need some kind of software to run this. There's several systems that can help you with competitive bidding. So it's those kind of softwares. The other resources that are more on kind of people and institutions is, your banks. Your banks are crucially important for Treasury. Banks can, help you when you're in a tough spot. Banks can get you the data that you need. If you run into, and it happens all the time, like, hey, we're in such and such country and they're asking for this letter of credit and I don't know how to set it up, but what is this type of payment, right? The banks are your experts on a lot of this plumbing that you need to put in place. So you need to rely on them. Plus, the banks give you other services like, I don't know, you want to start accepting credit cards, right? You can go to some kind of a fintech solution, or you can go to traditional merchant services solution. It's always a toss-up, but the banks do offer that service. If you stay within their ecosystem, you can leverage what they offer. And the beauty of it is, if something goes wrong, you have a person to call. Normally, for corporate relationships, there's a dedicated banker that services your account, and they'll pull the experts when they need to. So something goes wrong, you pick up the phone, you call somebody, says, hey, I need help. And these people are on the case helping you out. Whereas with a lot of other systems, you might be a tiny fish in a big pond, you're talking to the chatbot, right? So again, from the resources perspective, banks are crucially important. And there are other folks as well, like insurance brokers, right? Insurance is a very complex subject. Most companies, I've dealt with insurance for a long time. I can't say I'm an expert on every type of insurance. You have to rely on the experts, and the brokers are those experts that can help you not only place the policies, but answer your questions. Maybe you have an interesting contract with a vendor that does a certain type of work that you haven't faced before. And you're like, hey, how do I think about the risks of engaging this vendor, and what insurance should I ask them to carry? So you can run it by a broker, and they can give you some specific recommendations. So yeah, this outside ecosystem, outside the company, is crucially important to support healthy treasury.
I love it. And we're not going to get to anywhere near all the questions. We're running out of time. But if I think about some of the takeaways, and I want to hear sort of your final piece of advice for people thinking about building a treasury function, how to get started. We talked about some of the common signs that a company's ready for treasury. I can't explain where my cash is with confidence. I can't provide a reasonable cash forecast. I don't know and I don't understand, along with some complexities as you get into foreign currency or debt. Common sort of mistakes or insights I thought were really fascinating was, even if you can explain the cash management piece right, you might not be able to explain the risk right, which I think really broadened my mind and scope of what treasury could and should do. Your sort of final piece of advice to either both, or to one, companies that don't have a treasury function, and then people that do but really want to up-level their treasury function.
Yeah, if you don't have a treasury function, I'd say pay attention to your risks. And it's not just about treasury. Risks exist everywhere. It's a good thought process to say, hey, what happens if X occurs? Or what else could happen? Right? I apply that principle, across other finance areas too, right? You look through this risk lens and you have a process. Maybe it's AP, maybe it's AR, maybe it's something else, right? Like, what happens if some unlikely event occurs, unlikely but possible, right? I'm not talking about a meteorite striking the planet. I'm talking about something that, you could see at least several times in our lifetimes. What if it happens now? What do we do? Right? So start thinking about the risk function, and then the risk aspect of the treasury function. And then if you have a treasury function, and if it's kind of in this controller world that's really focused on cash management, try to broaden it out to, again, encompass the risk component, because the way you can deliver value to the company is, I call it, like, I solve problems before they become problems. Like, your job is to anticipate things and try to prevent them and solve them. You might not necessarily be the hero of the day, like the SVB collapse thing was like, oh, I'm glad we did this. But it's the small things. What you don't want to happen is something blows up and you look back at it as like, oh, this was so obvious. I should have known. Why didn't we think of it? So you want to think of things in a future, in hindsight, you don't think, oh my God, how did I possibly miss it? So it's a little stressful, but that's the mindset you have to have. And that's the way you might not be able to anticipate everything, but you'll be able to prevent things. The negative downside can be mitigated and prevented by doing this kind of thought exercise.
I love that. Solving problems before they become problems. What a great description of a role. Eugene, this was so awesome. Thank you so much for coming on the show. Appreciate it.
Yeah, no, thank you, Sasha. Really enjoyed our conversation today. Great show, and I hope the listeners enjoyed it as well. And again, if there are any questions, any feedback, I'd love to get some feedback.
And how should people get a hold of you?
You can find me on LinkedIn. I'm all over the place. Yeah, you can always look me up. I have a fairly unique last name, so you're not gonna miss me.
Thanks for tuning in to Turpentine Finance. Share it with your executive team, direct reports, friends, and family. And if you want to support the show, the best ways are to leave a review wherever you're listening and subscribe. Turpentine Finance is part of Turpentine, the podcast network behind Moment of Zen, Turpentine VC, Age of Miracles, and more. Shows for experts by experts in tech.